Welcome to How to Profit from the Coming Deflation, Strategies to Cope with Economic Slowdown and Financial Crises, presented by the Investment Education Forum. The Investment Education Forum is dedicated to providing books, courses, webinars, and conferences on topical investment management issues. We provide concise, actionable information geared toward the sophisticated investor and investment management professional. Our information is put together by professionals who are experienced in both education and hands-on industry experience. Our information is written and presented in a manner that describes markets and strategies in an understandable, practical manner. Our current courses are on behavioral finance, hedge funds and liquid alternative investment, and global investment strategies. In the future, we will develop courses on options, investment fraud, market bubbles, and foreign exchange. Let's go into the course outline. Before we get into investments to buy and investments to sell, we need to set the economic and financial framework. We start with the Great Moderation, the period between 1980 and 2007. Next, we go into the Great Credit Crisis of 2007 and 2008, which leads into the Great Recession that followed in 2008 and 2009. Then we go into the New Normal, which started in 2009 and is the economic paradigm for today as well. After we've done the economic and financial background, we go into investments to buy, and then we go into investments to sell or to avoid. Let's start with the Great Moderation. The Great Moderation was the name given to the business period that started in about 1980 and lasted till about 2007. It was said during that time period that we had the end of the business cycle. The period was characterized by steady economic growth, low inflation, low interest rates, rising stock and bond markets, and low volatility. The Great Moderation can be seen here in terms of the interest rates decline between 1980 and 1907, almost a straight line decline until interest rates reached about 5%. The investments in the Great Moderation were relatively straightforward. Investors had the wind in their backs. They had declining interest rates, which meant rising bond prices. They had stock market growth, they had commodity prices rising, and low volatility. Under those conditions, a traditional portfolio comprised of 60% stocks and 40% bonds earned 5 to 6% on average. Now let's go into the credit crisis, or the seeds of destruction. The seeds of destruction refers to the underbelly of the Great Moderation. In other words, during the Great Moderation, there were trends and forces that would lead to the credit crisis. For example, there was a savings glut. You had surplus nations that had export surpluses, like Germany, China, South Korea, who invested in export industry and therefore had massive reserves that they could lend to the US, UK, and to Europe. There was so much reserves to invest that there was a savings glut. Then there were the deficit nations, the US, UK, Europe. These nations focused on consumption rather than investments, and they took out massive debt in order to fuel or in order to fund their consumption. Emerging markets became very dependent on China's growth, especially those that exported commodities. The other seeds of destruction that we saw during this time period, even though it was smooth and low volatility, there were recurring crises and bubbles. In 1980, there was inflation and emerging market debt. 1987, you had the stock market crash. 1994 had the emerging market crisis. 1998 had the Asian and the Russian crisis. 2000 was the internet stock bubble that burst, and then 2007, 2008, the cataclysm of the credit crisis. This is an indication of the US stock market bubble between 1990 And the year 2000, before the internet bubble burst, you can see that NASDAQ especially rose precipitously over that time period. A little bit about bubbles, since we seem to have one every few years. Bubbles are a temporary or extreme increase in the value of assets. They're marked by deviation of assets from preceding prices and trends. They're often based on real technological breakthrough, like the internet, or other potentially transformative trends. They lead to suspension of economic and financial rules. One of the sayings during these time periods is that this time is different. And it's also marked by broad base of participation by investors. And the other thing about bubbles is that they're always followed by a crash. The extension of credit was another feature of the Great Moderation that led to the Great Crisis. After the internet crash of 2000 and the 9/11 fiasco, central banks lowered interest rates dramatically to around 1%. This led to an extension of credit and easy credit and led to a misallocation of resources. Countries like the US, the UK, Spain, and China took this extension of credit and put it into consumer goods, while countries like Germany and China put the money into export industry. In both cases, it was fueled by debt rather than income. Consumption was fueled by debt rather than income. This also led to asset bubbles. You had bubbles in housing in the US and the UK, and you had bubbles in real estate in other places as well. This is an example of the growth in credit in the private non-financial sector. This is both consumer credit and business credit, and you can see the rapid growth between 1980 and the year 2007, the exponential growth during that time period. In the US, the asset bubble showed up in the form of an increase in the price of houses. Here you can see again that the median family home, the price of the median family home rose dramatically during this time period, well above the trend that preceded it. The causes of the credit crisis are as follows. First, low interest rates and increased money supply led to an environment of easy credit and easy money. Then there were myths about housing. You had sayings like, can't manufacture any new land, or housing prices never go down. And then the role of banks. Banks lend to increasingly risky borrowers. They lend to subprime mortgage borrowers, for example. These are borrowers that had very low credit, very high credit risk. Probably the worst case was ninja borrowers. These were borrowers that had no income and no jobs. When the banks also innovated financial products that allowed them to package thousands of mortgage securities into one security, what they called a mortgage-backed security. The mortgage-backed security was divided into various tranches or various groups, and the top tranches received AAA rating from rating agencies. That's the highest rating that's possible. Then they took it a step further. When they ran out of mortgages to package, they took dozens of mortgage-backed securities and grouped those together into one security. These were called collateralized debt obligations, or CDOs. And again, the top tranches of these CDOs received AAA rating. This is an example of a mortgage-backed security structure. The complexity of it is really overwhelming. And down at the bottom, you see the CDO structure as well. Investors who invested in this mortgage-backed securities, which were pension funds and individuals and insurance companies all around the world, typically had very little understanding of how the tranches actually worked and how these mortgage-backed securities actually functioned. The fallout of the credit crisis is still very much with us. First, you had anemic economic or non-existent growth in large parts of the world. Before the credit crisis, growth was a respectable 3 to 3.5% worldwide. After the credit crisis, growth is more like 1.5 to 2%. And the reason for the slowdown in economic growth is severalfold. First, consumer spending investment in business investments are at lows. Income is stagnant, so that spending becomes much more difficult. Inequality in income and wealth have shown a marked increase, and the wealthy tend to spend less than the middle class, which also leads to economic slowdown. At the same time, market volatility is high. We're going through bubbles and crashes on a regular basis, and there is a risk of deflation. Inflation and interest rates are low, price increases are very low, and this threatens deflation. Finally, political conflict and gridlock in the US and other regions prevent any rational fiscal policies that could inflate the economies and could get growth back again. Investment returns are low and they're uneven. For investors, this is a particularly difficult time, as we'll discuss later in this presentation. This is an indication of the rapid decline in economic growth. In the US, economic growth went from about 5% down to around 2% over that time period. The factors behind the economic slowdown, first is because debt was overheated by consumers, businesses, and government. Now there's a great deleveraging where people have to pay off their debt, as do businesses and governments, which leads to low consumption and low investments. At the same time, there's a slow growth in income with high unemployment and slow economic growth. You had government paralysis that prevents fiscal spending, which is one way out of a recession. Banks are reluctant to lend for a variety of reasons. There's a risk of deflation because there's no demand or no credit available. There are low interest rates and low inflation. Because of the financial and political gridlock, central banks have been forced to take a central role in the economic crisis. First of all, there's something called the Greenspan put. Central banks have become the lenders of last resort. So when we have a financial crisis or a liquidity crisis, the central banks step in and lower interest rates and increase money supply. Now they have made interest rates down to near 0% and in some cases below zero in order to spur lending, spending, and investment. Then they engage in quantitative easing, which consists of the purchase by the central bank of billions of dollars in bonds from banks and from investors, and an increase in the money supply, again, to spur lending, spending, and investment. However, there's a limit to central bank intervention. Central bank intervention prevented the depression, but has not led to economic growth. The central banks have exhausted their tools. We have sub-zero interest rates. We have easy money, which has caused an increase in asset prices rather than an increase in investment and consumption. Stocks have come back to near 2008 highs before the credit crisis. Bonds have set new records, and there's a possible new bubble forming in housing and automobiles. This limit of central bank influence of the real economy as opposed to the financial economy, it shows the limitations of spending and investment. So where will economic growth come from in order to prevent the Great Deflation? Well, the truth is that there really is no visible place at this point. In the United States, for example, there is massive consumer and government debt that we saw before, and this needs to be worked down and repaid before there's a resumption of consumption and investments. So we have economic growth and inflation both under 2%, well below the historical averages. The trade balances remains negative, which means that we incur more debt over time. And short-term interest rates are below zero for short-term rates, and for long-term rates they're at 2.25, down from about 4.5% before the credit crisis. We're also looking at an increased price of housing because of the easy money and political gridlock that prevents fiscal policy. China also has its economic problem. Historically, China has had an economic growth rate of 8 to 10%. However, in the last couple of years, this has been cut down to 5 to 6%, which is still high for the rest of the world, but low for China. The growth in China has been fueled by exports to the US, to the UK, and to Europe. This has led to the great savings glut that we talked about before. China has also been an importer of commodities from emerging countries. The problem in China is that there has been an excess in government spending and in bank lending to the housing and the export industries. The bank's balance sheet in China is loaded with bad debt in housing and in local industry, and there's a strong possibility of a banking crisis when this bad debt is due. This is an example of the sharp decline in the Chinese stock market once investors realized that economic growth had slowed and that a bank crisis may be in the making. Europe also has slow growth with no pickup visible in the near future. First, like the US, you've had a debt buildup in the UK, Spain, Italy, and southern tier. A lot of that bank debt, however, comes from German exports. Germany has an export surplus and provides credits to other European markets so that these countries can in turn buy German exports, a cycle that leads to increasing debt on the part of the southern tier in Europe. This has led to crises in debt in Greece and Ireland, Spain and Portugal, and threatens crises in Italy and in France. Economic growth and interest rates and inflation in Europe are at 1% or lower, which is even worse than the United States. Central banks in Europe are aggressively pursuing quantitative easing and sub-zero interest rates, as in the US and in Japan. Japan has been for years a poster boy for economic deflation. Japan has been in an economic deflation for 25 years, since 1990. It's had near zero growth and near zero inflation during that time period. The government has tried all the financial tools available, sub-zero interest rates and quantitative easing. However, these have had very little effect on economic growth and on inflation. There are also bad debt on the books of Japanese banks that have not been written off and could cause a crisis in the future. And then finally, an aging of the population, which has caused a decline in consumption and a decline in productivity as well. The emerging markets have also suffered because of the Great Crisis. They survived the credit crisis by using reserves that they built up since 1988 in order to prevent repeat of past crises. In other words, emerging markets had crises in 1994 and 1998, and they built up their reserves to prevent that type of crisis. For a while, this worked, and emerging markets did relatively well during the credit crisis. However, this has gone downhill since then. The high interest rates in the emerging markets attract tourist dollars. Tourist dollars are short-term investors who are ready to flee at the first sign of trouble. And what we're seeing now is indeed capital export from emerging markets rather than capital import. Emerging markets also have a large US debt, both by governments and by industry. As their currencies depreciate, that debt goes up in value. And finally, the commodities-led boom that came from Chinese imports has slowed, causing low economic growth in countries that are dependent on their exports. So what investments should we be buying in this economic environment and with the possibility of deflation? Before we go into individual investments to buy, a few tips on investing. First of all, forecasting is notoriously difficult. Every era has its own peculiarities. However, there are larger trends that could be identified. As Mark Twain said, the future doesn't repeat the past, but it does rhyme. Secondly, the 60-40 portfolio that was used for many years is no longer valid, doesn't work anymore. The recommendations that are based in this course are ones that should be implemented through index funds and exchange traded funds, which is why we don't have recommendations for individual securities, stocks, and bonds. Then finally, there's a need to develop new approaches and models to investing in this new normal era. The first recommendation for securities or investments to buy is treasuries and high quality US bonds. A number of reasons for this. First of all, the exporting countries like China, Japan, Germany continue to hold trillions of dollars in US bonds. If they sold the bonds, the value of their reserves will decline. So it's unlikely that they would sell their reserves. U.S. treasuries and high quality bonds are also a safety haven during times of risk and times of volatility, which we're seeing regularly during these days. The interest rate on long-term bonds at about 2% plus is still higher than what you have in stock dividends. And then high quality corporate bonds provide additional yield. And at this point, U.S. companies are in good financial shape and are in fact cash rich. The next investment opportunity is in US dollars. The US dollar still remains the currency that is the flight to safety. Countries need to purchase US dollars in order to buy US bonds, so the large exporting nations have a continuous needs for US dollars. Commodities are also priced in US dollars, so oil and other commodities need to be purchased with US dollars. The US dollar is still the leading reserve currency in the world. And other nations are pursuing policies to devalue their currency against the dollar in order to encourage their exports. The next recommended investment is bond coupon payments and stock dividends. With low yield and limited capital appreciation, puts an emphasis on cash flow. Cash flow can come from bond coupon payments or from stock dividends. Longer-term U.S. bonds still provide a real return above inflation, and U.S. companies are in good financial shape and cash rich, which means that they can issue debt with spread over U.S. treasuries, and they're using cash in order to pay dividends. So corporate dividends for some sectors are attractive investment at this point. Food and consumer staples is another area for investment. Even with deflation, there's a continued need for food and for consumer staples. In fact, it's possible that these will go up as budget-conscious households cut back on eating out, travel, and big-ticket purchases. Deflation will also cause a decline in production costs as companies cut back, which should lead to lower prices for these staples. And the stocks of companies that produce food and consumer staples tend to be the ones that pay dividends. And then finally, we have healthcare and pharmaceuticals. These also include hospitals, nursing homes, biotechnology, funeral homes, in addition to pharmaceuticals. One of the main reasons for increased healthcare and pharmaceuticals investments is because of the aging of the population. The baby boomers are becoming senior citizens, which means an increased demand for healthcare and for drugs. The U.S. healthcare system provides a good background for pharmaceutical and healthcare companies. There's no cap on medical expenditures under U.S. care system, and providers have few incentives to cut back on expenses. In fact, the U.S. healthcare system encourages extra expensive procedures and medical supplies. How about investments to sell or to avoid? We start with big ticket consumer purchases. With low economic growth and low growth in income, purchases like automobiles and major appliances are not a good prospect for the future. This also includes large ticket leisure activities like hotel and like air travel. A number of reasons why this sector is not attractive. In a deflationary environment, consumers tend to wait before they make purchases, looking for lower prices in the future. Also, consumers are reducing their debt and increasing savings rather than spending their money on big ticket items. And then finally, a weak economic outlook means that consumers have less money to spend, less disposable income in order to make these large purchases. Another sector to avoid is credit card and consumer lending. The 2000s was a boom for credit card and consumer lending. These were primarily in automobiles and housing credit, which led to increasingly tenuous credit ratings of borrowers. Consumers are now working off their debt rather than spending, and credit card companies are having to deal with bad debt that they took on during the 2000s. And finally, debit cards and electronic payments are competing with credit cards for consumers. The home building and supply sector is another sector to avoid. During the boom of the 2000s, we had an oversupply of housing, and housing debt will take years to pay off. Homeowners, in fact, are walking away from houses, adding to this oversupply. Aging population is also selling their homes in order to fund their retirement. People are delaying purchases because of the economic uncertainty, and rentals have become very attractive and have replaced home purchases for many people. Commodities is another area to avoid. Oil dropped from $100 a gallon to $35 a gallon during the last year. This has led to many bankruptcies in the energy sector and energy industry. The economic slowdown means lower demand for commodities, especially in the US and China and Europe, all of which are in economic slowdowns. Another factor is that the US has switched from importer to exporter of energy. And then finally, a stronger dollar makes commodities more expensive, especially for emerging markets. Another sector to avoid are banks and similar financial institutions. Banks need to repair the balance sheet problems that they incurred during the 2000s, which limits the amount that they are able to lend. They had bad real estate and automobile debt from the 2000s that needs to be written off and needs to be repaid. Real estate derivatives like mortgage-backed securities, as well as lawsuits and regulation, are another hamper on lending. And then higher capital requirements imposed by the government in order to cover losses are another impediment to lending. Another factor here is the thin spreads between interest rates earned and interest rates paid. Negative interest rates means even less income for these banks. A slow economy means less borrowing by small and medium-sized businesses, as well as for consumers. Large companies are at this point not borrowing much because they're cash rich and because they're using the debt market rather than the lending market. Another area to avoid is industrial goods. With a slowdown in the world economy, there's a lower demand for industrial goods. Exporting countries especially are feeling this, like the US and like Germany, all of which need economic pickup in importing countries like China and the emerging countries. Global access capacity needs to be worked off in the industrial goods sector. Commercial real estate should also be avoided. There was a boom in commercial real estate during the 2000s, which led to an overcapacity of commercial space that needs to be worked down. There's also a buildup of debt in commercial real estate, and there are favorable rentals rates that people are using rather than buying commercial real estate. The economic slowdown also translates into lower demand for commercial space. Next, we have junk bonds and distressed securities. The debt issued by companies with financial difficulties or impaired cash flow is what we mean by junk bonds and by distressed debt. Junk bond prices collapsed with the credit crisis. Interest rate spreads over corporates increased, which led to an increase in the price of bonds. More recently, interest rate spreads over US corporates declined and bond prices have increased even more. This makes it a particularly bad time to buy these bonds at these inflated prices. Also, in addition, the economic slowdown will lead to repayment problems and increased bankruptcy, which will negatively affect these junk bonds and distressed debt securities. And finally, developing country stocks and bonds should be avoided at this point. The debt that's issued by these countries is hurt by a collapse of worldwide demands that has hurt emerging markets more than other countries. The collapse of commodity prices has hurt countries that are dependent on commodity exports. Capital flight has led to money leaving these countries rather than coming in, and also to export reduction, which has led to lower domestic demands. And a stronger dollar means higher debt for companies and governments in these countries. Thank you for your participation in this course, which has been presented by the Investment Education Forum. Further information and materials are available at www.investmenteducationforum.com. And good luck in your investing during this deflation period.